Diversify, diversify, diversify. You hear it all the time, right? But is that actually good? This is what I want to talk about today. So we've been told forever we got to diversify. And I'm just so you're clear, I'm not opposed to diversification, but I will say this, I like real diversification, not the fake kind that you're always told about. Because here's what we're always told, right? We're told to diversify our money. And this is something I taught when I used to be a financial advisor. As a financial advisor, I drank the Kool-Aid. I told you to set it, forget it, save everything, spend nothing, save it forever, put it in these mutual funds, and eventually someday you'll have something. And I would tell you that by putting it in the S&P 500, because that's diversified, right? Or throw it into the stock market in these different mutual funds where you're spreading all your risk, you're not putting all your eggs in one basket. As a result, you're diversified, and that's a smart thing. Here's the problem. If you're in stocks like this, if you're in mutual funds, you are not diversified. I repeat, you are not diversified if you have mutual funds or even the S&P 500. Why? Because the real diversification spreads your risk among different asset classes. Understand that there's 4 asset classes here. The first one is there's business, real business. This is not stocks. This is business. Like you own a business, you have it. It could be a franchise, right? Businesses are a particular asset class. It's very different than buying stocks. 2, we got real estate. Real estate, I will tell you, if you have a mutual fund that's a REIT, that is not buying real estate. You are not in real estate. You are buying a copy of it. And by the way, those companies suck when they buy real estate properties. The third one are paper assets. These are the things that every financial advisor offers you and only offers you. Mutual funds, stocks, bonds, options, all these kind of things. Heck, even life insurance is a paper asset. Now, paper assets aren't bad, but notice that's all they recommend. And then the fourth one are commodities, gold, silver, oil, things like that. Those are commodities. And by the way, just because you own maybe an oil company does not mean you're invested in oil or commodities. That's a very different thing. This is why so many people like talking about gold mines and stuff. They're like, oh, I'm in gold mining companies. Well, guess what? Historically speaking, gold mining companies do worse than gold. If you buy real gold, you do better than the gold mining companies. And so be very aware that when all these financial advisors are telling you, well, you invest in all these things, you invest in corporate America, you're investing in America, in the future of America, you believe in it. Well, do you know everything you're invested in your mutual funds? By the way, all that diversification, do you even know whether those mutual funds are in companies that you might hate? They might be companies that you don't believe in or do things that you don't like. How many times have people, it's like, oh, I hate Philip Morris and all the cigarettes and things they do in killing people. Oh, guess what? Philip Morris is in your portfolio because they're diversified, right? Oh, yeah, I hate these companies or these companies. I hate these companies because they kill the environment. Well, guess what? You got at least 10 of those in your portfolio right now. Are they bad? Do you like them or not? Well, I'm making money. I'm supposed to diversify. Oh, so you really do like investing in those companies. And just so you're aware, you're not really investing in those companies that much. You're not even moving the needle. Your diversification into Apple stock, I'm sorry, Tim Cook doesn't give a crap about you right now, right? Because it's the truth, is that you're really not even heavily invested in those companies anyways. Now, here's the problem. Again, they tell you you're diversified, but you're not. This is why every time we see stock market crashes, people lose money. Even if you have bonds, bonds are supposed to be the opposite. They're supposed to be the secure thing when stocks go down. But guess what? 2008, bonds went down like stocks did. 2022, the one down year we've had in 16 years, bonds went down and stocks went down. Everything went down. So you would have lost money regardless. And so you think you're diversified, but really you're not. You're all in the same place, the same paper assets. And this is what happens is when everything goes down, everything goes down. Yes, you've got different stocks, but the unfortunate thing is that most of those stocks do follow. Just so you're aware, even if you have the S&P 500 index right now, you're not diversified. I've had so many people say, well, that's the best investment there is, the most diversified investment. Well, did you know that the top 10 of the 500 stocks in the S&P 500 make up 40% of that S&P 500 index? Because it's a weighted index. The biggest companies get a bigger percentage. Well, 10 stocks only make up 40%. Even NVIDIA, our little AI friend, NVIDIA makes up 8%. Do you know, never in history has one company made up such a large percentage of the S&P. That should scare the crap out of you because it's so tech heavy. That means of that 40%, most of those are tech companies. If the tech sector alone drops, your whole S&P 500 portfolio drops. This is why we've also seen, because of the AI tech boom, and really it's just overinflating massively on the AI side. Again, I'm a huge fan of AI, but they're overvaluing it beyond what it's actually producing. What's happening is they're creating this big bubble in the AI bubble now. And when that comes crashing down, your diversified S&P 500 is no longer diversified. You are actually at big risk. So don't for 1 second believe that stupid financial advisor who only gets paid to make money off of you, not make you money. Don't take their advice. Don't even believe anything that even the financial media says. They say you're diversified, because Wall Street's been lying to you the whole time. If you want to be diversified like the wealthy are diversified, you do want to have more of those asset classes. So yeah, maybe you keep some of those paper assets. Maybe you keep the S&P 500 index, but don't go all in. If you're all in on paper assets, if that's all you have, which if you've met with financial advisors, that's all you have, start diversifying. Maybe buy real estate, not just your own home. Maybe you start buying and investing in real estate, which doesn't have to be properties. Now, properties are good, right? But did you know you can lend money to real estate investors and have the property as collateral? You could be the bank for real estate investors. You can do those kind of things. You can actually invest in joining together, pooling your money together with other investors to buy things like self-storage or apartment buildings or even commercial buildings, Amazon warehouses, whatever it might be. You can buy those things and have ownership interests in those. So you can diversify into that. You can actually buy gold, silver. You can actually invest in oil and gas. I actually have ownership in an oil and gas company, an actual business partnership in that. So it's a little bit of business, but it's also oil and gas, very much related to the prices of oil and gas. I also have gold and silver, real tangible gold and silver that I have that of course has been appreciating like crazy the last couple of years, right? So you have business you can invest in. Yes, I have my own business. It could be your own business. It could be other people's business. You could be a silent partner. I actually have a business that's backed by real estate with raw land, and it's a business where those guys are running the actual raw land business, buying and selling and flipping these properties. That $500,000 or so that I've invested is now generating well over $150,000 a year. And so you can do things like that to actually build and diversify your portfolio. So the great thing is, even if some things go wrong, you're okay. You're now truly diversified. Now, I have a little bonus tip here. If you want to be more diversified, don't just buy assets that grow, also get assets that cash flow. And I didn't mean to make that rhyme, but it happened this time. If you want to learn how to do that more, go to moneyripples.com/consulting to figure out how you can create your own personalized work optional blueprint to help you become financially free in the next 5 or 10 years. Check that out now.